I think something's changing in this market. Look, we should have gone down Friday huge after that gigantic Thursday rally. We should have gone down and stayed down this morning because of the FTX scandal. Something that definitely would have crushed a less vibrant market. And we should have been slammed all day when Chris Waller, an important Federal Reserve Board governor, said this weekend there's a ways to go before the rate hikes end. Instead, we get hit in the morning, and then next thing you know, Lael Brainerd, the Fed's vice chair, used the word soon in relation to a slowdown in rate hikes, which is exactly what the bulls want to hear, and then we had a nice bounce until we did indeed roll over. At the end of the day, ultimately Dow sinking 211 points, S&P losing 0.89%, NASDAQ falling 1.12%. But the fact is, this market put on quite a show for most of the day before some late-hour selling. You want to know why this market has become so resilient lately? I think it's because of thinking like we got from Vice Chair Brainerd. If the Fed's not going to tighten aggressively from here, still tighten definitely, but not aggressively, the bears won't have enough fuel to keep mauling the averages. Now, you might think this is happening too painlessly, but that's actually not true. It's where the pain is highly concentrated. We're seeing layoffs and closings left and right. Think crypto or lunatic techno apparel ideas or fattened up enterprise software firms that have done so well for so long they've never needed to bother with efficiency. We're starting to see some layoffs at Amazon. I think there are many more to come there. Larger ones at Meta Platforms. And I bet there'll be more coming from big tech. Does Alphabet really need all these people, including the ones they just added? Does Microsoft? I don't think so. They've just made so much money for so long at these companies. Maybe they just don't know how to fire. Now, if we look at anything tech, fintech, real estate tech, enterprise software tech, or anything that needs advertising tech to make the quarter, we know exactly who is feeling the pain.
The house of pain.
It's just less visible to those who don't work in tech. And it's not just that they're firing people. So many of these tech companies offer their employees tons of what's known as stock-based compensation. Yeah, a big part of their income is from stocks. But now that their stocks have collapsed, a lot of that compensation is going up in smoke. Still more has to be perhaps paid out in cash. The purchasing power of these people is being destroyed, and the companies aren't doing as well once we see what's really happening. Once you pull back stock-based compensation, you'll see they're not doing that well. The pay's also in the companies we've never heard of. The startups that were supposed to come public and didn't. The ones David Solomon, CEO of Goldman Sachs, talked about last week. He explained that there's a queue to come public, but to me, that's a queue to nowhere. There's no appetite for IPOs here, and it won't come back until the market's more secure.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.